Hello and welcome back to Accounting Stuff. I'm James, and in this compilation video, I'll teach you everything you need to know about assets, liabilities and equity. Well, nearly everything. Let's get started. What are assets, liabilities and equity? Assets, liabilities and equity are the three main components of the accounting equation. The accounting equation says that a business's assets must always be equal to its liabilities plus equity. This formula is built on a very simple concept, which can give us a feel for what these three terms mean. The stuff that a business owns is equal to the stuff that it owes. A business owns assets, and it owes liabilities and equity. It owes liabilities to third parties, and it owes equity back to its owners. Well, that's the gist of it. Now let's take a closer look at each of these terms to see what we can learn about them. We'll begin with assets, the stuff that a business owns. I think most of us have kind of a preconceived idea of what an asset is. We think of an asset as something that we own, that's useful or has value, something along those lines. And that's not far from the truth, although the definition of assets in accounting is a bit more specific. Assets are probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. Say what? I know. What on earth does that mean? Let's break the definition down and try to make some sense of it. The first word that stands out to me is probable. Assets are probable future economic benefits. The word probable carries with it a degree of uncertainty, and I want to emphasize this because I think that often we take numbers for granted without questioning them. The reality is that the future is uncertain, and a lot of the time we accountants have to make estimates. Let me give you an example. If you're running a business and you've got 10 clients who all owe you money, can you say, hand on heart, that you'll receive back every penny? It's not uncommon for customers to go bankrupt or to dispute invoices after the work is done. So what accountants do in these situations is make an allowance for doubtful debts. We estimate what might not be recovered and expense it to provide for situations where there's uncertainty. And that brings me on to the next part of the definition. Assets are probable future economic benefits. What are future economic benefits? These are the things that bring value to you or your business either directly or indirectly. Valuing assets based on future economic benefit means that we can't simply hold them in the books at the value that they originally cost us. Imagine you buy a laptop today and you plan on keeping it and using it entirely for work. Will that same laptop carry the same future economic benefit in 5 years' time? Probably not. It might well have cacked it by then and not be worth anything anymore. It can be hard to measure the lifespan of a laptop. So instead, we assume that all laptops have a useful economic life of, say, 5 years? Useful economic life is a term that you'll hear often when talking about assets. It's how long an asset will remain useful to you, and it's different to an asset's actual life because useful economic life is an estimate. So if that laptop cost you $1,000 today and we assumed a useful economic life of 5 years, then we would depreciate or reduce its value by $200 a year for the next 5 years until it's worth nothing at all. Is this an exact science? No, clearly not. But estimates like this are used every day to simplify scenarios and help accountants value assets. Lastly, I want to bring your attention to another part of the definition. Assets are probable future economic benefits obtained or controlled by a particular entity as the result of past transactions or events. Obtained or controlled. This highlights another important concept that we use in accounting called substance over form. This means that when preparing financial statements, we prioritize the economic substance of transactions over their legal form. An example of this is when a business rents a building for a long period of time, say 60 years, and that building's remaining useful economic life is 65 years. Although the business is considered a lessee and technically doesn't own the building, the economic reality of the situation is that basically they do. Make sense? Because they have the right to use it for the majority of its remaining useful economic life. Following this principle of substance over form, we can account for this building as an asset, even though legally it isn't. That has big implications for the accounting and tax treatment of the building. Now, I'm oversimplifying this situation. There are a few other factors to consider when making this call, but that's the gist of it. Okay, so now we know what an asset is. Let's run through some examples of common assets that you should know about. But first, and bear with me here, a balance sheet is a snapshot of a business's assets, liabilities, and equity at a single point in time. In the assets section of a balance sheet, we list out all of the different types of assets that a business owns or controls. These assets are often arranged in order of liquidity. But what is liquidity? You can think of it as how quickly you can turn an asset into cash. And following that vein of thought, assets in the balance sheet can be divided into two distinct categories: current assets and non-current assets. Current assets are the ones that we can convert into cash in a short period of time, typically within a year. The three types of current asset that show up most often are cash, accounts receivable, and inventory. Inventory is your physical stock, or the goods that you intend to sell to make a profit. When your business sells inventory, your customers owe you money, which we call accounts receivable. And when your customers actually pay you, your accounts receivable turn into cash, the most liquid asset of them all. Other current assets include prepayments and short-term investments. You can think of prepayments as situations when you're paying for something in advance. Rent is a good example because most of us pay rent at the start of the month. At the moment that rental payment is made, we need to recognize a prepayment as an asset in the balance sheet. It's an asset, even though we aren't going to convert it into cash, because we're going to get some of that sweet future economic benefit out of it. Remember the definition? Not all assets convert into cash. Short-term investments can be made when your business has cash to spare. You might choose to put some of that money to work by investing it in stocks and shares. This investment is considered to be a short-term investment or current asset if you're in it for the short game and you plan to sell those stocks or shares within a year's time. However, if you want to hold on to them for longer than a year, they become non-current assets instead. Non-current assets are long-term assets that are used in operations to generate profits and that can't easily be converted into cash. There are three main categories of non-current asset. The first, which we touched on a moment ago, are long-term investments. These are the investments that we plan to hold on to for longer than a year. The other two categories of non-current assets are tangible or intangible assets. Tangible or fixed assets are the ones that have an actual physical presence. You can actually touch them. The most common types are land and buildings, or PPE, which stands for property, plant, and equipment. These include things like furniture, machinery, and cars. But not all assets have a physical presence. We call those that don't intangible assets. Intangible assets include things like intellectual property, patents, royalty rights, trademarks, and copyright. If you're a photographer, then you might own the royalty rights to some of your own photos. If a company wants to use one of your images for their website or blog, they should pay you a royalty fee to recognize your work. So this intellectual property that you own is bringing you probable future economic benefit. It should be an asset, right? The answer is sometimes. The thing with intangible assets is that they can be very difficult to value. How can you calculate the future economic value of your own licensed photos? You can't really. So most of the time, businesses don't capitalize intangible assets that they've generated internally. What does capitalize mean? When we capitalize something, we record it as an asset in the balance sheet as opposed to expensing it in the income statement. We only capitalize intangible assets that we've purchased from someone else, and these are held at the cost value that we paid for those assets, or a lower amount because we amortize intangible assets to decrease their value over time, much like we depreciate fixed assets. An intangible asset that doesn't fit into the category of intellectual property is goodwill. Goodwill is the amount that one company is prepared to pay for another over and above the fair value of its net assets. When Facebook bought Instagram back in 2012 for something stupid like $1 billion, were Instagram's net assets at the time worth that much? Not by a long shot. The majority of that purchase was for goodwill. That's the premium that Facebook were happy to pay for Instagram's brand and potential future earnings, over and above the fair value of their net assets. Interesting. Was that worthy of a like? Possibly. Now let's do a deep dive into liabilities, the stuff that a business owes to third parties. Hold on tight, because you're about to hear the full accounting definition of liabilities, and it ain't pretty. Liabilities are probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. What the? I thought the assets definition was bad, but this is something else. Let's break it down and see if we can make any sense of it. Liabilities are probable future sacrifices of economic benefits. The word probable hints at uncertainty. When dealing with liabilities, we accountants often have to use our own judgment of situations to estimate future outcomes. This is especially the case with accruals, which I'll get into later in this video. Future sacrifices means that we're going to need to give up something in the future. And what are we going to give up? Economic benefit, which relates to the things that have value, or more specifically, assets and services, and that doesn't only mean cash. This definition also says that liabilities are present obligations resulting from past transactions or events. So in order to recognize a liability, the transaction or event that is committing us to transferring assets or providing services must have happened already. Yikes, are you still there? I hope I haven't lost you yet. It's important to understand what liabilities are because they're a crucial part of normal business. A simpler way to think of liabilities is that they are a source of third-party funding that a business uses to buy assets and fund operations. If we bring that accounting equation back up, then we can see that businesses have two broad financing options to choose from when buying assets: liabilities and equity. Does that make sense? I think things might become clearer with some examples. Let's find out. Now that we've got a feel for what liabilities are, let's talk through some of the common types of liability that are worth knowing about. To get a summary of a business's liabilities, we can take a look at its balance sheet. A balance sheet is basically a snapshot of a business's assets, liabilities, and equity at a single point in time. In the liabilities section of the balance sheet, we list out all of our different liabilities. Typically, these categories are arranged in order of their due date, with the short-term liabilities at the top of the list and the longer-term liabilities further down. Short-term liabilities, or what we accountants like to call current liabilities, are a business's obligations that need to be settled within 1 year from now. The most common type of liability is accounts payable. Accounts payable relate to the bills or invoices that we get sent when buying something from the supplier on credit. But why would a business want to buy something on credit? And for that matter, what does credit even mean? Buying something on credit means that you're agreeing to pay later, or if your head works like an accountant, you're making a present obligation to transfer assets or provide services to another entity in the future. In a standard business transaction, we have two parties, a buyer and a seller. The seller provides the buyer with a product or a service, along with an invoice or a bill, and in return, the buyer sends them cash to settle the payment. However, sellers sometimes like to incentivize buyers to spend more money and bring their purchases forward by offering them credit terms. Picture a restaurant buying some ingredients from a food wholesaler. One day, the restaurant realizes that they've run out of carrots, a vital ingredient of their award-winning minestrone soup. It's Friday morning and they're stressing out about it because it's going to be a busy night, and to make things worse, they're running low on cash. Larry, the restaurant owner, dials the local food wholesaler and says, "Hey mate, look, we're badly in need of some carrots, but the issue is, I'm a bit strapped for cash right now." "Larry, don't sweat it. You're our best customer. We'll have those carrots delivered to you right now. And don't worry about the cash. We know you're good for it. We'll add 30-day credit terms to your invoice." "You legend. I knew I could count on you." The seller, despite the risk of reduced cash flow, has offered Larry 1 month credit terms, which they note down in the invoice. This suits Larry well because he likes to buy things on credit. Having a 1 month grace period gives him flexibility to manage his cash flow. Oh, did you hear that? The countdown starts when they receive the invoice, and in 30 days they make the payment. Transaction complete. From an accounting point of view, when the buyer receives the invoice from the supplier, they recognize an accounts payable balance for the amount that they owe. And on the other side of the transaction, the seller recognizes an equal and opposite accounts receivable balance for the same amount. One person's accounts payable is another's accounts receivable. Another kind of current liability is salaries payable. Most businesses employ staff that they need to pay, obviously. When does that payment usually happen? Well, it depends, but often it's at the end of the month. So when the books are prepared at the end of the month, we need to recognize a balance for salaries payable. Businesses also have to pay tax on the profits they generate, so they need to recognize taxes payable on their balance sheet as well. Next, there's interest payable. So you might have noticed by now that most current liabilities include the word payable, which makes them easy to identify. But that's not always the case. Accruals, or accrued expenses, are adjusting journal entries, typically posted by accountants at month end to recognize expenses that have been incurred but haven't been recognized yet in the books. Let's refer back to Larry. The restaurant is fast approaching month end, so Larry gives his accountant a call. "Hey buddy, would you mind getting our books up to date? I'd like to check our performance for this month." "Of course. Are there any accruals that I need to post?" Yeah, we had a plumber in last week to fix the dishwasher, and I don't think they've sent us an invoice yet." "Ah, right you are. What did they quote?" He didn't say, but last time it was $500 for a similar job. In this situation, the restaurant has incurred an expense during the current month because the plumber has provided them with a service. However, they haven't received an invoice, so the liability and the expense haven't been recorded in the books yet. So Larry's accountant posts an accrual in the books to recognize an accrued liability and an expense of $500. This is an estimate because there's no supporting invoice to match the transaction to. But by recording this transaction, Larry's accountant is ensuring that the business's income statement and balance sheet will give an accurate picture of the restaurant's financial performance when Larry comes to review it. Geez, we've got a lot of current liabilities here, and that isn't even all of them. Two other big ones that I haven't even mentioned yet are unearned revenue and short-term loans. You can think of unearned revenue as the opposite of a prepayment. They come up when someone pays you for a good or service in advance. Now that might sound like an asset, and you're right, cash is an asset, but we're double entry bookkeeping, so there's another side to the transaction. In this case, it's unearned revenue, which is a liability because you have an obligation to transfer assets or provide a service in the future. Short-term loans are exactly what it says on the tin. They are loans that need to be settled within 1 year from today, but short-term loans can also refer to the current portion of long-term loans, which are non-current liabilities. Non-current liabilities are obligations that aren't expected to be settled within a year. There are many types of non-current liability. I'm going to mention a few now, but I'm not going to get into the nitty-gritty because this video could go on all day, and who's got time for that? When a business wants to raise money from outside to fund its operations or invest in new assets, it has a couple of options. It could seek a long-term loan from a bank or financial institution, who in return will expect to be repaid with interest. Alternatively, the business could choose to issue bonds instead. Bonds are similar to loans, but the key difference is that the money is raised directly from the public. You can think of them as formal IOU notes. You'll still be charged interest, although it may be cheaper than getting a loan from a bank. The flip side, however, is that bonds are less flexible. Other non-current liabilities that I think we've all heard of are mortgages on properties and employee pensions. And a lesser known one is deferred income tax, which is definitely for another day. But you can think of it as a byproduct of the timing differences between your accounting and taxable profits. That wraps up current and non-current liabilities, but I mentioned earlier that there's a third category: contingent liabilities. These are less common than the other two, but nevertheless, it's worth being aware of them. A contingent liability is a potential obligation that may arise depending on the outcome of an uncertain future event. It can be risky to ignore contingent liabilities because the outcomes can be serious. Let me explain. Our favorite restaurant owner, Larry, has a problem. One of his customers slipped and fell in the restaurant and broke their wrist. They're suing the restaurant for damages because there was no wet floor sign. If the outcome of the litigation is probable and can be reasonably estimated, then the contingent liability should be recorded as a loss in the income statement and a liability in the balance sheet. However, if the outcome is only considered to be possible or remote, then the liability might only need to be noted in the footnotes of the restaurant's financial statements, or not even disclosed at all. Management need to make a judgment of whether the outcome is going to be probable, possible, or remote. And that decision will influence the accounting treatment of the contingent liability. Okay, so we've covered assets and liabilities. Now it's time for equity, the stuff that a business owes to its owners. There are two ways to look at equity. At the start of this video, I promised you two definitions of equity in accounting, and here's the first. Equity is the residual value of an entity's assets after deducting all its liabilities. That's it? Hold on, I'll explain how this works. First, let's bring up the accounting equation again. You'll be seeing this quite often in this video, and it'll become clear why later on. Assets are equal to liabilities plus equity. If we rearrange this formula, then we can see that equity is made up of assets minus liabilities. Now, we accountants have another word to describe assets minus liabilities: net assets. I said a moment ago that equity is the residual value of an entity's assets after deducting all its liabilities. Residual value basically means what's left over after you take all of an entity's assets and deduct its liabilities. In other words, what we've got here. Equity represents the net assets of a business. Simple, hey? Yes, it looks simple, but what does it actually mean? Definition number 2 is going to help us shed some light on this. It says that equity represents the net funds invested into a business by its owners. I like this description of equity because it gives us some context. Let me explain with the help of the accounting equation.
On the broadest scale, there are two ways that funds can be invested into a business to finance its operations, and you're currently looking at both of them. It could choose to borrow money from third-party lenders like banks, which in essence are liabilities, or it could choose to use the net funds invested into the business by its owners. In other words, it could choose equity. So now we know that equity represents the net assets of a business, and at the same time, it represents the net funds invested into the business by its owners. So what we're saying here is that the owners of a business own or have a claim on all of its net assets, and we call this equity. Make sense? Now that we've got an idea of what equity means, let's have a look and see what it's actually made of. Full disclosure here, equity is made up of a lot of things, and some parts are a bit complicated. But I mentioned at the start that I've cherry-picked the parts that I think are most important, that will give you the most value. 3 in particular that together will give you a solid understanding of what equity is, and I'll share them with you in a moment. But first, I think it'll be easier for you to picture all of this if we work with an example. Imagine that you've got an idea for a business. You've been following the plastic-free Feb movement on the internet and you've come across this video.
90% of all...
Gross. You realize that plastic makes up 90% of all ocean debris. So you come up with an idea to decrease the number of plastic bags by developing your own reusable shopping bag to help save the planet. But there's a problem. You have a choice to make that all startup businesses end up facing. How to structure your business. You could choose to go it alone, become a sole proprietor and avoid incorporating the business as a separate legal entity. You could go in 50-50 with a mate and form a partnership, or you could decide to create your own corporation, a separate legal entity that's owned by its shareholders. Now there are pros and cons to each of these, but that's for another day. Let me know down in the comments if you'd like to hear more about it. I want us to rewind for a second. I said that equity is essentially made up of 3 things. And the reason why I've laid all this out here is because the words we use to describe these 3 things changes depending on the structure of the entity. And I think that's partly what makes equity seem so complicated. There is so much different jargon that we use to describe what is essentially the same thing. Let me show you. The first thing that makes up equity is capital contributions. Capital relates to the funds raised to support a business, and contributions simply mean that these are given to the business. So capital contributions is the money that the owners invest into the business out of their own pockets. Now the way that we describe this changes depending on who the owners are, and that changes based on the structure of the business. If you're a sole proprietor, then there's only one owner, you. So you'd call the money that came out of your own pocket owner's equity. However, if you were part of a partnership, then the owners of the business would be the partners, so you'd call the capital contributions partner contributions. And if you created a separate legal entity, a corporation, then the owners of the business would be the shareholders, and you'd call the funds invested shareholders' equity. So we have 3 different terms that describe basically the same thing. Capital contributions are one of the ways that businesses tend to fund themselves during the early startup phase, before they become profitable. Imagine that you choose to become a sole proprietor, at least at first, and you invest $1,000 of your own money into your reusable bag business. What's your business's financial position? Let's bring up the accounting equation again. Your business has assets of $1,000 in the form of cash, and you, the owner, have a claim of $1,000 on those assets, which we call owner's equity. The accounting equation is in balance, as it should be, because when we're looking at a snapshot of a business's assets, liabilities, and equity at a single point in time, we're looking at its balance sheet. Now, capital contributions aren't the only thing making up equity. When your business generates revenues or incurs expenses, it'll make a profit or a loss, which is just revenues less expenses. What happens to that profit? And who does it belong to? You, of course. You're the owner, so you could choose to reinvest these profits back into the business or hold on to them to use in the future. Over time, these profits and losses that you're holding on to build up, and we call them retained earnings. Retained earnings are defined as accumulated profit held for future use. And thankfully, this term stays the same regardless of whether you're a sole proprietor, a partnership, or a corporation. Your business's equity is made up of 2 things: capital contributions, and retained earnings. Over time, your reusable bag business starts to make some real money. So much, in fact, that you no longer need to dip into your own pocket to fund it using capital contributions. You can cover all of the expenses using the accumulated profits that you've held onto and set aside, your retained earnings. Within a year, your business is booming. You've got much more money coming in than what's going out. In other words, you've got a net cash inflow. But back home, all is not so rosy. You've invested so much of your own savings into the business through capital contributions that you're running out of money to live on for yourself. You need to withdraw some cash out of the business to cover your own personal expenses. Well, how does that work? Retained earnings are made up of a couple of things. Remember I said that they're your accumulated profits held for future use. So a big chunk of your retained earnings is your accumulated profits, which are your revenues less your expenses, which comes straight from your income statement. An income statement is a financial report that you use to track your revenues and expenses over a period of time. But retained earnings are also made up of withdrawals, the money that's taken out of the business and distributed to its owners. We have different terms to describe withdrawals depending on the structure of your business. For sole proprietors, we call them drawings, and for partnerships, we call them partner drawings, and for corporations, we call them dividends, which are profits distributed to the shareholders. Again, we have three terms, all used to describe what is essentially the same thing: withdrawals. As the sole proprietor of your reusable bag business, you can use drawings to withdraw your accumulated profits for personal use. This impacts the accounting equation by decreasing assets because the business's cash has gone down, and decreasing equity because your claim on those net assets has decreased. Hold on, now I want to show you something interesting. We've broken equity down into capital contributions, retained earnings, and withdrawals. But let's see how this all fits together using the accounting equation. Earlier, I said that when we look at a snapshot of the accounting equation at a single point in time, we're looking at a balance sheet. The balance sheet is made up of three things: assets, liabilities, and equity. And we know that equity is made up of capital contributions from the business's owners and retained earnings, which are its accumulated profits held for future use. Retained earnings break down further still into accumulated profits less withdrawals. And accumulated profits are a business's revenues less expenses, which when looked at over a period of time make up its income statement. So what we've got here is the expanded accounting equation. And I like this because we can see how two of a business's major financial statements, the income statement and the balance sheet, are linked together through equity.
So there you have it. Assets, liabilities, and equity are the three pillars of the accounting equation. Remember to subscribe for more accounting tutorials. You can find my cheat sheets and practice questions over here. And if you'd like to learn more, then why not watch this video next? See you soon.